Welcome to Futurewise Energy, where we break down the latest trends and events shaping the world of energy. Today, March 18th, 2025, we're diving into a critical 3 to 4 day snapshot of the U.S. oil and gas sector from March 14th to today. Buckle up, because the energy landscape is shifting fast, and the stakes couldn't be higher. Let's begin with the Permian Basin, the powerhouse of the U.S. oil production. Over the last few days, it's been the talk of the industry. Why? Because the data and the chatter on the platforms like X suggests that we might be witnessing a turning point where production in the Permian, which accounts for nearly half of U.S. crude, could be peaking or even plateauing. Low oil prices are squeezing operators, and the incoming Trump administration's drill baby drill mantra is adding pressure. But here's the kicker. OPEC Plus is set to ramp up supply next month, starting in April. That's a global curveball that could force U.S. producers to rethink their game plan. Zooming out to the bigger picture, U.S. shale production is showing signs of strain. Estimates peg current output around 12.8 million barrels a day. That's down from 13.2 million not long ago. Posts on X are buzzing with this crude oil production has been flat for almost 2 years. What's keeping the numbers afloat? Natural gas liquids like propane and butane, not crude itself. This isn't just a blip, it's a trend that's raising eyebrows and sparking debates about whether we've hit peak shale. Now let's talk frac crews, the muscle behind shale extraction. Over the past week, the U.S. frac crew count ticked up slightly to 212, a modest gain of 2. But rewind a year, and we're down 57 crews. That's a big drop in hydraulic fracturing muscle, hinting at a slowdown in the upstream hustle. Fewer crews mean less new production coming online, and that's the signal that we can't ignore. So what's trending? First, there's growing concern over U.S. shale that may have peaked. Sentiment online warns of rising energy cost if production slides further. Second, low oil prices are a double-edged sword, great for consumers, brutal for producers. With OPEC Plus unwinding cuts, the market could get flooded, testing U.S. shale's resilience. Third, natural gas is stealing some spotlight. Associated gas from oil wells is propping up output, but pricing remains a wild card as we look toward 2025. And finally, policy looms large. The Trump administration's push for more drilling is coming, but it can't, or can it, overcome market realities like low oil prices and potentially tapped out productivity of shale in the Permian. Here's where it gets real. The Permian's facing declining productivity and shrinking inventory of drilled but uncompleted wells, down to just 4,500, an all-time low. Industry watchers like those at Deloitte say capital discipline and tech investments are the future. But right now, the vibe over these past 3 days is cautious. Some are even predicting higher energy bills if this decline sticks. And reported in the last hour or so, a major Permian operator announced a 5% cut in its 2025 drilling budget, citing unfavorable market conditions. If confirmed, this could be the first domino to fall, signaling tighter output ahead. We're keeping our eyes on the wire for more, because moves like this could ripple across the sectors. So what does all this mean for the future? Well, the U.S. upstream sector is at a crossroads. The Permian's still king, but its crown could be slipping. Shale's glory days could be fading, and the global players like OPEC Plus are ready to pounce. Add in policy shifts and natural gas wildcards, and 2025 is shaping up to be a thriller. We'll be tracking this story as it unfolds. Think of it as energy's next big plot twist. For the latest, check the Energy Information Administration or World Oil, and stay tuned to Futurewise Energy. Until next time, keep your eyes on the horizon.